Hello, everyone. Thank you so much for joining me for this episode of Demystifying Money. I'm joined by my friend Charles Freeman. He is a portfolio manager and investment strategist and the owner of Adapt First Tax and Investments, where he helps clients build portfolios and tax planning and strategies for tax-efficient investing, long-term wealth strategies, and he has a unique, disciplined, research-driven approach to personal finance. I've been working with Charles for a long time, helping build the portfolios at Soundview Financial Advisors. I do like the way that, we've kind of changed from, I think a lot of times with investing, there's different approaches you could take, passive, active, tactical, and I think that there's usually not necessarily one right answer for everybody, but I do like the way that we've started to, kind of dig into what's going on in today's economy, dig into different complex investment strategies so we can really help the clients in the best way possible for them. So, and he's also a CFA, which is one of the grisliest tests, I believe, in the financial services industry. So he knows his stuff. Thank you so much, Charles, for joining me today.
Yeah, thanks so much for having me. I'm excited about it.
This episode of Demystifying Money with Misty Lynch is proudly sponsored by Soundview Financial Advisors. Visit www.soundviewfinancialadvisors.com to learn more.
So you have a unique background. I know that I think you came to New York for fencing. Is that right? But tell the audience how you got your start in finance and what's got Adapt First Tax Investments to where it is today.
Yeah, it was kind of a crazy story. I was a fencer at Carolina, and I got an opportunity to move to New York to fence at the New York Athletic Club after school. And one of the guys there, I was actually a marketing emphasis in business school, so I was thinking actually of going down the advertising route. And one of the guys at the fencing club said that if I was going to try to do advertising in New York City, then I would be working 100 hours a week. He was working as a trader down on Wall Street, and his firm was hiring, and he got me an interview, and that's kind of how I got started from there. So
yeah, no, I think it's interesting. A lot of us end up, but I think the marketing background and advertising, I think it helps all business owners in a lot of different ways. I talked to plenty of people who've kind of started out that route, went in a different direction, but going from working in New York at a larger firm, what led you to want to start out on your own and be an entrepreneur?
yeah, so I lived in New York, worked there for a few years, but I'm from North Carolina, here in central North Carolina, a small town called Kernersville. And I have a big family, and I miss being home. You don't really appreciate the small town until you kind of get away from it.
Mm-hmm.
So I wanted to move back home, and I did that after 3 years. And after I came back, I started having family members. My uncle was actually my first client, and he wanted help with his 401k.
Mm-hmm.
And so that kind of what led me down the path of personal finance and financial planning. And so helping my friends, my family with their stuff, and it's kind of grown from there.
I think, a lot of times that's definitely true about small towns. I think, you can't wait to get out of it when you're younger, and then you think back about, what you left. And so it's good to, to be able to have that flexibility and help people wherever, because everywhere in the country, everybody has financial planning and personal finance needs. Like you mentioned, your uncle with his 401k, really that formal training, that education is not widely accessible to everybody. So, I think with a lot of times it does end up being like starting to figure out what the need is and figuring out how to fill it. But it's changed for you from, from what you were doing in trading to the tax and portfolio management. So what kind of drew you into that side of finance?
Yeah, so it's been a little bit of a journey because I was doing a lot of high volume trading early in my career, and as I transitioned into financial planning, that's a shift of kind of focus. I looked a little more longer term with clients' assets, and then also with the tax. That's actually a more recent addition. I have done a lot of research on markets and kind of the macro economy where we are. And one of the things that I determined was that tax planning is going to be one of the biggest issues over the next 20 years.
Mhm.
If you think about like the debt that we have, the deficit spending that we continue to do, I think tax rates over time are going to start going higher. And so one of the things I wanted to do is increase my tax knowledge. So I got an additional certification as an EA, that's an enrolled agent with the IRS. And also I started working with my CPA and helping him actually prepare returns and doing more tax planning. Because to me, the disciplines kind of join together and they overlap in so many ways. So one of the things we're trying to do is be very holistic in how we think about investment management and tax planning and financial planning.
Investors today hear tax efficiency a lot, but what are some of the most practical, smart tax moves that everybody, and I feel like most people, they might not consider themselves an investor, but they probably do have some investments, whether it's their home, whether it's in their 401k. What are some things that everyday investors could look out for?
One of the things that I think is very common today that I've seen is being able to utilize ETFs
Hmm.
versus mutual funds when it comes to taxable accounts for investment. A lot of mutual funds will kick off capital gains, even
Hmm.
though the fund is not actually sold. So whereas an ETF, it's more tax efficient in that you don't actually capture, a gain until you sell the position. So, the investment vehicle is actually one thing. Um, Something else, tax loss harvesting kind of
Hmm.
goes along with that every year to where basically I look at if we've made trades throughout the year, I see what kind of taxable gains are in the account. Is there a loss that I can utilize to offset that gain to minimize taxes for the client for that particular year? We can always, wait and reinvest if I still feel like that's a good opportunity.
Hmm.
But we can basically try to use some strategies like that to minimize, um, taxes for them.
Right, because I think that's one thing that a lot of investors, they love to see the gains and the growth, but also the taxes sometimes will be, where they can't. And I always feel like you shouldn't necessarily, you know, not invest or not do this because of the tax conflicts or ask for a raise because you might pay more in taxes. But I do think having those efficiencies, those strategies as far as what vehicles you use, whether it's exchange traded funds or mutual funds. And also, like you said, looking at selling some of those losses to offset gains, it might not even have much of an impact on your portfolio if you invest in something similar. So I think those strategies are really important, but also I think that's where sometimes professionals can help look at these things because it can be overwhelming, I think, for a lot of investors to think there's so many exchange traded funds out there. There's so many mutual funds. Which one is right for me. So I think sometimes that it can be difficult for people who are trying to get started where they might have that overwhelm and not start at all. So
Right.
super
And you may,
important to think about that. But there are different ways, and a lot of wealthy people pay less in taxes because they have a tax strategy.
right, right,
And
right.
so important for all investors, everyone, savers, anybody to think about that tax impact and how it can really impact the returns you have. Another
And
thing that comes up a lot in conversations when it comes to tax planning, with my clients and people I talk to lately, as they're approaching either retirement, or they have a lot of money saved up in pre-tax accounts, maybe in their 401ks, their IRAs, and that's Roth conversions. So can you talk to me a little bit about the tax implications of converting, using a Roth conversion and some of maybe the misconceptions that people have about that?
mhm. Yeah, it's a really hot topic right now. So I bought the tax practice a year and a half ago, and I'm looking through our clients' tax situations. And one of the things that I think is really important, Roth conversions are going to be huge, I think, in the coming years because there was a rule change to where if you inherit an IRA, like a pre-tax IRA, then the beneficiary needs to take that money out over 10 years. And one of the things that I'm starting to see is that the people that are actually inheriting these IRAs, right, they are typically in their peak kind of earnings years. So their incomes are already, pretty high if they have a good job. Well, then you have to add on a pretty sizable distribution to be able to get all of the money out over that 10-year period. Well, what it's doing is pushing them into much higher tax brackets. So, and this is really compounded if it's a large, amount, like a
It's a
million
large,
or $2
yeah.
million, right? So, you could really actually be pushed into the highest tax bracket.
Mhm.
And one of the things that I think is going to be important that rather than doing that, you could basically take chunks every year for the person, the parent,
Mhm.
right? And they could still, do the conversion. They're going to owe tax on that the converted amount, right? But the taxes are going to be less than if they waited and then
Mhm.
ended up passing that on later because it's being layered on top of the income they're already making. So I've been actually talking to quite a few clients about that. The other thing that I'm actually running into, which is kind of an interesting, it's kind of the opposite of that, is
Mhm.
that clients who they're only making just drawing Social Security, maybe taking some minimal distributions. But one of the things I'm seeing is that the standard deduction now is so high
Mhm.
that basically they're not even utilizing the full standard deduction because they don't have enough, income
Mhm.
outside of Social Security. So what's interesting, like one client, I was able to just convert $25,000, and they're actually going to pay no tax on that money
Mhm.
because the deduction actually takes their taxable income down to zero. So that's kind of another way that a Roth conversion comes into play, where you're maximizing the deduction, or you're actually saying, hey, we know that the kids are going to be in a much higher tax bracket, so let's go ahead and minimize the taxes by taking some of that money now before it gets passed on. So a couple of different ways to utilize that strategy.
What factors should someone consider before converting? You mentioned their own tax bracket and the standard deduction. But is there anything else you can consider? I know a lot of people are really anxious to do this. They want to do this, but also they might be paying quite a bit in taxes themselves if they were to do this strategy. Should they look at, where this breaks even or where this would pay off if there's somebody who's maybe an early retiree looking to take advantage of this strategy? And maybe it's not for wealth transfer. Maybe it's just because they want to not have to pay as much in taxes in the future, or they're seeing these large required minimum distributions in their future that
Right.
they aren't really excited about paying the taxes on.
Yeah, I mean, I think one of the things about the Roth IRA is that there are no required minimum distributions for it. So, it makes sense to go ahead and, hey, let's pay some of the taxes now, especially what I was talking about with regards to the debt and the deficit,
Mhm.
to where if it's kind of like we're in a situation, kind of like what happened after World War II. And we had a very large debt to GDP.
Mhm.
And one of the solutions outside of that was, all of the tax brackets were raised. So, I think going forward that longer term is one of the sort of the path that we're on. And so it would really make sense to probably go ahead and pay some of those taxes now, knowing that, down in the future that those tax brackets are going to be raised. So there's a lot of different benefits to a Roth, and like you said, on the accumulated gain. So that client that I moved the
Mhm.
25,000 over for, not only was I able to kind of save them the tax money on that because they're utilizing that standard deduction, but all of the gains on that money going forward, right? They're not taxed. So if it was left in the pre-tax amount, then it's going to accumulate, and then it's even more that's going to be taxed. So by doing the Roth conversions kind of ahead of time, we're saving on the front end by utilizing standard deduction, and then we're also all those gains are not taxed as well. So
Yeah, I know it's not something that every family thinks about, but I do know I do talk to people who, especially when they looked at their financial plan and they see the wealth that they've accumulated and what that could look like over time if we're looking at an age 90, age 95. But it's a tricky conversation sometimes to get started with families talking about wealth transfer. What are some ways, if you are talking with a client that you've approached the topic about wealth transfer and maybe trying to help clients balance living really well today and leaving something meaningful for their family?
mhm. I think it's a very personal thing. What I try to do is get people to imagine, especially if they're right sort of in the years leading up to retirement or sort of right there, what is it that you've always wanted to do, right? Do you want to, downsize and have a beach house, or do you want to travel in, go traveling in Europe several times a year? It's important to kind of have that vision and then sort of map out, okay, these are the assets that you have, and can it fund, that vision without there being any red flags? And if so, what can we, if we can project out how much might be left over for the kids? So I kind of look at that and try to help them think about it. And the other thing, where it's kind of a hot topic for us, has been long-term care. Yeah. Because my grandmother actually just went through a 6-year period where she had Alzheimer's, and she went through all the different stages of care, home health care, assisted living, and then memory care and skilled nursing care at the end. And that can really absorb a lot of assets, depending on what kind of plan you might have in place, or if you're gonna, kind of pay out of pocket, those kinds of things. So I think it's like kind of thinking about, what your vision for retirement is. What are some contingencies, like, if you had a healthcare event, and do you have enough assets to support that lifestyle? Mm-hmm. And then if so, that's awesome. Can we also project what's going to transfer? And then what's the best way to do that?
Yeah, those are all things that I think a lot of times once you experience it, once you see a family member have to pay for long-term care, or you see somebody in your family, I know I have family members that have lived to 96 years old. Like, it doesn't seem as out of reach when you experience that. And so I think it's important for everybody to kind of think about those things. But even, as you do the tax planning and the strategy, maybe you use the money for long-term care. Maybe your family members inherit it. All of these things, but figuring out what's the best way to fund this. It might be similar where you don't have to choose one or the other, but it might be, okay, we're going to have this money down here down the road. What's the best thing we could do for it today to take care of it? Which leads me to another investment related topic. I talk to a lot of people that, because of the high interest rates in high yield savings accounts, have a lot of cash sitting on the sidelines. And one of their thoughts is, well, it's here and it's safe and I can see it. I'll get back in the market when things calm down. What are your thoughts when it comes to people who maybe, and this could be at any point in time, I think, I can't even think of a time where it was just, nothing going on. Everything was cool. But for people who, we just had the government shutdown recently, all of these things going on. When you have investors asking, like, what should I do in this market? How do you help them kind of figure out a strategy that'll work, knowing that markets are going to shift and have volatility?
Mm-hmm. It's a really difficult question, actually. And one of the things I've started doing is kind of segmenting money in the sense of, so I did a lot of research on behavioral finance years ago. And I designed it's about 23 questions and a risk profile that I will give to my clients. I've been doing this for 25-ish years now. And basically, I kind of see different profiles of investors, right? So I kind of guide them through, or ask them all these questions to kind of see what category they fit into. And, a lot of times, like, let's say they come out as what I would call a balanced investor, which is kind of a maybe middle of the road, like a moderate is another term that a lot of people use. So they might be normally a balanced investor, but to your point, what if they have this like big chunk of cash? They don't want it to just kind of sit in the bank per se, right? But balanced, if I put them in a more balanced portfolio, that actually might be a little too much risk, So one of the things I've started doing is segmenting accounts to where we might drop that in a more conservative portfolio. So we'll still have some market exposure, but it's not as much as maybe their normal risk profile. So we're hoping to earn a little bit more than we get at the bank, but we're also not taking as much risk as we might normally do, if that makes sense.
Yeah, I think that that's one thing that, we do get we all know that things are getting more expensive. We all understand inflation and we see it. And so I think a lot of times when, when interest rates come back down and savings accounts or high yield savings pay 1, 2% again, I think there is a risk that your money won't be able to do as much in the future. So I like the thought of kind of segmenting the money because maybe you do need some money for a goal that's happening next year or 2 years from now. But maybe this, depending on, how you keep your money and where it is, you don't necessarily have to treat it one way. I've talked to people who say like I'm aggressive or I'm conservative. And I don't necessarily, I feel like I'm aggressive in my Roth. I'm conservative in my high yield savings and then with my kids 529 plans, I'm moderate because they're going to school in the near future. I don't feel like you necessarily are one thing, but your money does have different jobs. And so I think that's what's really important with the tax strategy and really knowing, I think it's good to have a baseline. Like, yeah, no, if I saw those numbers, I'd feel sick. Or if I saw those numbers, I'd buy more. And I think people kind of know where they land there. But it is important to kind of look at things individually, kind of figure out how much cash is too much. Maybe what number feels good to have in the bank. So that's where that behavioral finance piece I think is so important because sometimes we just feel and think a certain way because that's what we've always been told. I remember working with a person once who retired and said, "Oh no, I'm not supposed to ever touch that money. My dad told me never to touch that retirement money." And I was like, "You're retired." Is absolutely when you're supposed to touch that money, but in her head it still felt wrong. So we hear things and we learn things, but a lot of times we're not necessarily know why we feel that way until we really poke around at it. So super important to kind of use those questionnaires, figure out, okay, maybe I haven't thought about that this way. And then
The other
make
thing
sure
that
that
I
you're making
do,
decisions not out of fear. Go ahead.
yeah, and the other thing I do that's probably a little different than most people is I do try to take a more proactive approach to risk management. So even in my clients where they would come out as like a balanced investor, I think it's really important to kind of think about where the market is and kind of where what's going on with interest rates and like the tariff thing is a big issue right now. Like where do we think markets are going to go? It's important to kind of think about what are the influences over the market over the next 1 to 3 years, and how do we want to be positioned accordingly. So it's not saying that we should, take a big position necessarily, but maybe tilt the portfolio. Like we want to be diversified. And I'm very big on diversification, but it's important to kind of say, okay, here's an opportunity we see, like let's take advantage of that. So it might be in a certain sector, or like on the bond side, it might be given duration or something like that. But I just think it's really important to think about where the market is right now and adjust accordingly. So I do that with my clients as well.
I think that's also a way because I was thinking about how investors could prepare mentally for volatility, market conditions. And I think that is a different approach. And I like that we implement that where we will tilt in a certain direction. We are not day trading here, but I do feel like there are changes. There are things that we can maybe look at and say, okay, this is the way the world is right now. And these are maybe some things that we can add or take away to kind of maybe keep things, diversified, reduce risk, but also take advantage of what's real today. So I think, a lot of market, we look back, historical performance doesn't mean anything, but it's kind of like you're going into, the future. You want to know what's like, if you're going on vacation, you don't really care about the weather forecast last week. You want to know what the forecast is next week. And so I think that's a really important thing for people to think about because things are changing, the economy's changing, government's changing, how quickly people step in. And so really market conditions, you could look back 50 years ago and it's kind of a lot of changes have been made with how quickly, government steps in. So important to kind of look at things today and kind of prepare for things to change, but also realize that that's where opportunity comes. So,
Yeah,
but just, yeah, go
I
ahead.
told a guy the other day, we were talking about this, and I said, the thing about it is like if you take a purely like passive
Mhm.
approach, right? most passive approaches are still pretty diversified,
Mhm.
but
Yes.
the idea is that you kind of set this allocation and you sort of forget about it. And if, to your point, like if the market is the same like it was over the last 50 or 100 years, then this is going to give you the optimized
Yeah.
kind of return for that. But what if it changes?
Hmm.
What if, bonds, as a good example, really bond yields have been going down since the 1970s,
Hmm.
right? And they went all the way down to zero. So not only did you get the interest rate off of the bond, but you also got the principal appreciation, right,
Hmm.
for those prices going up. Well, now, bond yields have come down so much that they've just started to kind of rebound.
Hmm.
So we're kind of entering a new regime to where bond yields might be more range bound. They could potentially be going up because if people are worried about credibility of the U.S. and repaying some of the debt and things like that, that would require higher bond yields.
Hmm.
So it's a very different sort of regime than what we've had over the last 50 years. And if that's the case, well then what does that mean for our portfolios?
Hmm.
Because especially as we get older, the conventional wisdom is to have more and more of your assets
Hmm.
in bonds.
Right.
But how do we, if we are entering this new regime, does that still make sense? Does that strategy make sense?
Mhm.
So it's really important to kind of think about, like you said, what's changed, and then what are we looking at over the coming years?
I think that it's something that comes up a little bit. You mentioned bonds and diversification, but what are some ways that other alternative investments, different things like commodities, real estate, how do they fit into a plan? Because a lot of times they're kind of boxed out of some of the traditional passive portfolios, but how can they help investors in different economies?
hmm So they can really provide an additional level of diversification. One of the things that we've seen over the last, I would say 60 to 80 years is that as the world has become more connected, we've lost some of the diversification benefits
Mhm.
across, stocks,
Mhm.
right? And those are some structural issues that have allowed that. So bringing in alternatives really can help you to not have all of your eggs in one basket.
Mhm.
And that's where something like commodities, especially, can be huge. I mean, we've seen the run in gold and silver
Mhm.
as an example over the last couple of years, and that's been a huge positive influence for portfolios. And so not everything is kind of tied to the stock market. And gold specifically can be considered a safe haven asset. If we look at historical crashes in the market or downturns when investors get really nervous, they look at gold as a
Mhm.
safe haven. So again, it can provide, maybe if stocks are going down and people are selling and they're looking for something safe, gold is often a lot of times is a place where that money flows through. So really can what you want to think about with diversification is the relationships across asset classes and how they move relative to one another, because the idea with diversification is that no matter what happens in the market, you know, is what happens to your portfolio, and that's again where if you are too tied to one asset class, then you can see that level of volatility in your portfolio really range quite sharply. Versus if you have a more well diversified portfolio, that this asset class might be going down because of XYZ reason, but this other asset class is going up, right? Because the money's kind of flowing from there into here, and our overall portfolio is not getting hurt too bad.
Yeah, it's definitely interesting to think about where money is moving because it's not like it just disappears when it leaves somewhere, or something goes down. It's always moving somewhere, which is
Right.
another thing I wanted because I've also talked to a lot of people that maybe have fallen in love with some of their winners. Maybe they have done
Mhm.
well with crypto or AI tech, and they don't want to diversify because this has been so good for them. But what are your thoughts when it comes to other, and I think that that's just an interesting topic where people are looking at that now is how much growth they've seen in certain areas. And I still think it makes the case for diversification. But what are your thoughts when some people are maybe thinking about all of this growth and wondering, is this, are we due for a crash? Is this a bubble? Like, what does this mean? So how do you kind of talk through investors, fears on that end?
Yeah, it's really interesting because I mean a lot of what I'm seeing today reminds me of what I saw back in when I first started my career. So I started my career in 1998.
Hmm.
So it was right at the end of the tech bubble. And the first few years that I was trading, 98, 99, and into 2000, I mean, we saw a lot of the same things. There's been a lot of similarities between Cisco, who kind of
Hmm.
built the infrastructure for the internet, and NVIDIA,
Hmm.
right? And one of the things that it's kind of maybe I was scarred because I sort of was kind of went through that period. I saw like the enthusiasm and the euphoria around tech at that time, and how it was going to change the world, and it did. I mean, it was a breakthrough for us as humanity and civilization, like this technology breakthrough. But that doesn't mean that the Nasdaq didn't go down, almost 80% over the coming years after the tech bubble kind of blew up. So, one of the things I think people tend to forget is that markets move in cycles. And if you look back, and I just saw a chart about this yesterday, for the longest time, GM was one of the best stocks in the market, right? And then it's Apple, right, has been over the last couple of years. Well, now Nvidia has kind of taken that throne. So at different points in time in market history, you can have dominant industries or dominant companies. But what we've not seen is any one continue that forever, right? It'll be there for a while, but then competition comes in, or maybe the expectations are too high and they can't meet them. So I think that's the thing you have to be really careful about, because like you were talking about earlier, we were talking about taxes, and I've seen in my career numerous, I can't even count how many times, to where I've seen stocks that have been bid up and they've gone up to super high levels, and then the narrative changes.
Yeah.
People don't sell it because they don't want to pay the
Hmm.
taxes, right?
Yep.
Or they're like, oh, it's going to come back. It's going to come
Hmm.
back. It's a temporary downturn. And then it goes down more, and then it goes down more, and then it goes down more, and then they basically lose all of the gains that they had. So it's really difficult I mean, it's great when you've had a stock that has performed so well, but to your point, to get um, you know, develop sort of a relationship with that stock, like you're
Yeah.
attached to it.
Yes.
You're like, it's been so good. Like, and what
Yeah.
if it keeps going more?
Hmm.
And I think it's a really hard emotional barrier to overcome. Kind of goes back to the behavioral
Hmm.
financing. But I do tell people, don't let, taxes, for instance,
Yeah.
drive the bus on making this decision, because, it's better to go ahead and take the gain, pay the taxes on it, and then we can always reinvest in it later. Like, let's say it comes down to a more reasonable valuation.
Hmm.
Maybe they still have good prospects, but don't ride it all the way up and ride it all the way back down.
Yeah. That happens a lot too with people who get, employee stock participation, where they end up having a lot of stock in their own employer, plus their paycheck tied up in their employer, and a lot of everything kind of locked in there. And so, sometimes I'll just ask people, if this was cash, would you put it in your employer stock today? And a lot of times they're like, no. It's okay. Then we're gonna figure out a strategy when it comes to your incentive stock options, your RSUs, all these things with what we should do. Because again, like you said, sometimes you are emotionally attached to the outcome and the company or the stock, and important to kind of try to separate that piece out and make
Mhm.
those decisions accordingly. Because, like you said, they can have huge tax implications where you might you might be afraid to sell or not want to sell because now your basis was so low that
Right.
the tax implication is huge. So super important to kind of always, and like you said, building like that tax planning in with the investment strategy. They're just so intertwined that it
Mhm.
is really important, I think, for everybody to kind of consider that with all the decisions they make and kind of look at it from that lens. But for somebody with a 401k, IRA, or taxable account, is there any like quick audit or questions that you'd have for them to kind of assess if their portfolio is balanced correctly? Anything that they could look at to kind of maybe if they've never thought about it before, take a peek at it and see if they're in the right place?
Yeah, I think I mean the thing that I've ran across quite a bit lately is with I mean as well as the market has done, as an example, what it's done is it's kind of overweighted stocks
Mhm.
relative to bonds or if they have some commodities or other things in there. So what it's literally done is it's shifted people's asset allocation much higher than they might want to be, right? And so I've been trying to reiterate it's important to just kind of reassess your risk level, especially like where you are in your life. And I think that's something that a lot of people don't really understand is that so markets again kind of move in cycles, right? Well, the market cycle doesn't always align with where you are in your life. So you might be ready to retire, right? And but if you retire and then the market goes down over, like, let's say has a rough patch, maybe we go through a recession or even like a consolidation and you start taking systematic withdrawals from that. Well, if the market's going down and you're taking out the withdrawal, it's kind of a double whammy, right? It's called sequence of returns risk. So what that will do is even though the market comes back up later, like after the tech crash, the market rebounded, right? But what happens, but those withdrawals make it harder for your portfolio to recover. So it's really important to kind of think about what your risk level is and looking at your account and saying, okay, one, like I come out as a balanced investor and I want to make sure that I'm balanced, but also, kind of where the broader market is relative to that financial plan strategy. So there's a couple of different things I
Mhm.
think you need to try to just kind of keep monitoring to make sure that your investments are aligned with your goals at all times.
Yeah. No, I think it is super important to look at those things. And also sometimes people think they have diversification because they own different funds or different ETFs with different names, or maybe they come from different custodians, but also super important to look at what those underlying holdings are, the top 10 holdings. I've seen a lot of people who think they have diversification and they own a lot of funds that own the exact same companies. So I think that's one way to kind of dig a little bit deeper. And somebody thought that having it, the S&P 500 index fund from this and then this one was diversification, or the Schwab and the Fidelity this were different. And they really, really kind of was like a suitcase packed with the same stuff. It's just a different
It is.
suitcase.
Yeah, that's such a huge point right now in today's market because one of the things we actually are in the most concentrated market we've ever had. These companies they call them the Magnificent Seven, and they've been phenomenal,
Mhm.
right? Like Apple, Microsoft, those companies have done so well since the financial crisis of 08, 09. The challenge is that they have become such a big part of the S&P 500 that the other 493 are actually not even really represented anymore. So really, it's what happens with those companies that's dictating the market, and that's again another kind of red flag that's out there because we have seen things like this in the past. It's actually worse than we've seen in the past because
Mhm.
it is the most
Cool.
concentrated now. But even like I was referencing the tech bubble, the top 10 there, and it wasn't even all in tech. That's the other issue, kind of a nuance about this time around is they're very related. They're all kind of around this AI theme. And So when you have a very concentrated market like that, it's great as the market's going up, but then again, there's a lot of embedded volatility. And so that if the narrative starts to change, and this is kind of what happened with the tech bubble, the narrative started changing. It was harder and harder to meet expectations. And then when people started to sell, it kind of became self-reinforcing. And markets tend to go down 3 times faster than they go up because people just start selling and then that begets more selling. And so it can happen relatively quickly. So you have to really be kind of aware in markets like this that you kind of think you're diversified to your point, but if all of those funds are kind of invested in these same, 7 to 10 stocks, you're really not as diversified as you might think.
Yeah.
So,
No. And I think that that's where, just doing, even if it's just getting educated on what you have or doing a little bit of research can be super helpful. If somebody listening is feeling overwhelmed by investing and taxes in general, where do you recommend that they start?
certainly, working with a credentialed professional like yourself is, I think, a great place to start because, you know, you have to be really careful about going to the internet and doing research. There's websites, and a lot of people are looking at TikTok
Mm,
videos to make financial decisions, and I think you have to be really careful about that. I think working with someone who again has an established credential helps you to kind of filter out the noise, and they have experience, and can help you navigate some of these things and answer some of those questions.
it's a good point. I do think there is a lot of tax advice. I think there's a lot of people asking, like, can I write off my car? Can I hire my baby? Can I do? And it's like, you don't own a business. What are you doing? Like, they're seeing these things that maybe worked for some people, but they might not be applicable at all to you in your situation. So, and those people are
Yeah,
getting paid by views and clicks and likes. That is their goal, not necessarily having a regulator making sure that they're giving sound
right.
financial advice. So super important. That's definitely a good point. And there's a lot of information out there and it's moving around a lot faster. So definitely important to kind of, figure out what's right for you. I think before we used to get advice from people holidays at our dinner table or whatever, but now it's really coming from everywhere. And
Right.
so not like any of that advice is necessarily great for you. But I feel like, working with somebody who really knows you, your tax situation, your goals is so important. How can listeners learn more about your work at Adapt First or connect with you? I know I found you because of your writing. I loved the blogs and things you were putting out on LinkedIn about the market. I thought it was super interesting. And that's how we got connected in the first place years ago. But how can other people find you these days if they're looking for more?
That's a great question. I've kind of had to put my writing on pause a little bit because in buying the
You're
tax
so busy.
practice,
Yeah.
it's so overwhelming
I
that
know that's the tough part about writing great content. It takes a while.
yeah, it
The
really
time.
does, and I miss it honestly.
Yeah, I bet.
So my goal this year is to try to get back to that on a more regular basis. Just our website www.adaptfirst.com is a good way to reach me, and yeah, I'm on LinkedIn. So if you want to message me on LinkedIn, I'm happy to respond there as well. I just haven't as active as I have been in the last couple of years. So.
Yeah, no, that's how it works. Well, thank you so much for joining today. I think, what I want everybody listening, even if you don't consider yourself an investor, all of us pay taxes. All of us have to look out for ourselves and our own, financial future. No one's coming to say, I think we've all kind of learned that lesson by now. So very important to you really just, even if this is something that intimidates you or it's not something that feels natural to you, it's really important for everybody to get more comfortable. And even listening to a podcast like this, you're doing the right thing by starting to just expose yourself to these topics. And I think that this is really something that anybody can get a better understanding of if they really just spend a little bit of time, a little effort, whether finding the right person to help them or figuring out, some ways that they can help themselves do a better job in whatever economy we're in. So if you'd like to set up some time to work with me to look at your finances or catch up on old episodes of the podcast, please head over to mistylynch.com. I'd love to hear your thoughts on this episode, and we'll talk again next week. Thank you so much for listening. Don't forget to share with friends and family, and together let's demystify the world of money. Knowledge is the key to financial empowerment.